Welcome back to Lamb's Cryptoverse. If you like our production cost series, please hit the like button and subscribe. I would really appreciate it because we're trying to build up our subscribers here and views. So today we're going to discuss part 2. If you recall, part 1 of Bitcoin production cost talked about the top-down view, right? Looking at the forest from the trees. And this entailed basically looking at crypto charts, on-chain metrics. Now today, we're going to talk about production cost in terms more of bottoms up, but we haven't reached there yet. That's going to be part 3. There's so much to consider. When you're looking at fundamental analysis, there's a lot more to think about. You need to think about what's the data and what's the data behind the chart. So today, we're just going to spend time talking about things to consider and think about. So let's get started. So again, there are 2 ways of looking at things, top down and bottom up. This presentation is going to be more on bottoms up. And I made it, as I said earlier, into more of a PowerPoint presentation so you can go back and revisit it, and you could even take snapshots of the charts that I have. So let's talk about some of the sources that I used. And there are many others, but these are the main ones. In order to attain production cost of Bitcoin, I looked at regression model from Glassnode, and I didn't like that. If you recall from the last presentation, Glassnode never told us how they calculated that production cost. They called it an all-in production cost, but the cost was way too low. So that's not good at all. That's useless. And then you could also look at private asset managers, but I have low confidence in that because the problem with that is we don't know where these asset managers are located. And when I say asset managers, I meant companies that are consultants, and we don't know where their data is coming from. I meant to say where their mining data is located. Are they doing surveys of mining rigs in the United States? Are they overseas? Or where are they? And remember, it's much cheaper to mine Bitcoin in some areas and some geographies where they have hydropower than it is in places like Texas. So so I have low confidence in private asset managers. How about sell-side research? Well, there's a few issues with that. Number one, there is no sell-side research. And if there is, there's very little. And right now, all I have is JP Morgan. And their sell-side research is basically based on the Cambridge Bitcoin Electricity Index. So what does that mean? It's just based on electricity. And obviously, you can't just base the production cost of Bitcoin just looking at electricity. And as you can imagine, electricity costs, not only do they vary, but within a region, they're very volatile depending on the temperature, right? If it's very hot out, people put on their air conditioners and they drive up the price of electricity cost. Or if it's very cold out, you get the same thing. You get electricity costs going up because some users use electric heating. So that's not good either. And then you've got consultants like Macro and Micro that seem to be doing a good job on surveying production costs for Bitcoin. And then, of course, you've got publicly traded companies, and I put the tickers here, like Bitfarms, Core Scientific, Hive, Hut5, Marathon Digital, Riot Blockchain. I think this is a good place to find production cost. And lastly, you've got private companies like the Mining Store. This is a pretty big company that has its own mining rigs, and they even host mining rigs. And they do give out their production costs, but they don't give detail of where these mining rigs are located. So they don't give enough granular information. So let's talk about or revisit some of the top-down charts here. So last time we talked about top-down charts like mining revenue, but these charts, as you can see in the title, they don't. I put they don't tell you anything. They don't tell you enough. That's what I should have told you. I mean, if the mining revenues are declining, we know that's near a bottom, right? We know miners are suffering, but how much suffering, we don't know. And this here is what I talked about earlier. This is the difficulty chart plus the regression line. But I said earlier, the Glassnode regression line that gives you 17,223 all-in production cost, it's not enough. We don't really know what that means. So what's mining profitability composed of? Well, it's influenced by many, many factors. You've got the halving event, and we all know what that is. That's the 4-year period when the reward is cut in half. It's cut by 50%. And we won't get that for another maybe 2 years until May of 2024. And this is not in concrete, but that's around the time when the reward is going to go into decline by 50%. And of course, mining profitability is influenced by the price of Bitcoin. It's also influenced by the hash rate. And it's influenced by GPUs and ASICs and CPUs. So basically, that's the price of the equipment that's running these mining rigs. And as I said earlier, mining profitability is affected by power consumption of that electricity. And maybe they're using renewable power, we don't know. And they're affected by rent and maintenance. And another very important factor that people don't talk about is depreciation. Because the problem with this industry, even though it's a technology industry, it's almost like looking at the energy industry or some other hardware intensive industry. Not only that it depends on a lot of capital cost, the useful lives are short for Bitcoin mining. I think it's less than 4 years. So you have a constant depreciation rate, a constant need to spend money on the next great efficient mining rigs. And then there's the issue of stock-based compensation. That's a very high cost. But do we consider it a cost? It's a non-cash cost. So Graham and Dodd, aficionados, they consider stock-based compensation a direct cost, even though it doesn't affect cash flow. And then there's the cost curves. Do we have a cost curve like we have in energy? But that's not even available in this industry. So here's how production costs look as calculated and represented, and I should say presented by miners when they present to an audience of investors. This is what they show. They show this complicated formula. This formula, unfortunately, does not tell us, it's very detailed, but even though it's detailed, it does not tell us the production cost per Bitcoin, but it does give a lot of information. So that's the problem with this presentation of mining cost. This would be nice. This is what you see in energy. This is the cost curve that I like to look at, and it shows the steepness of the all-in cost curve for the energy industry. Now you want to see a steep curve because when you have a steep curve, it shows that the industry is less efficient. And that means that when prices go down in oil, these more expensive companies in energy, like oil sand companies and shale companies, they will exit the industry. And then the more competitive companies will stay there. And so this is good when you see this happening in energy. Unfortunately, we don't have this in the Bitcoin mining industry. We don't even know what the cost curve is. But one last thing I should say is that when this industry is flat, when this cost curve is flat, that means we have more of a monopolistic competition versus oligopolistic competition. So when it's monopolistic, that's a nice word, when it's flat, when the cost curve is flat, you basically get a race to the bottom. So we don't want that. So it'd be nice to see what this cost curve is, but we don't have it. I would suspect that the cost curve for mining is similar to what you see here. And why do I say that? It's because we have a shift towards renewable mining. And when you have that shift, that means you have new rigs that are very expensive because they're renewables, right? And renewables, as you know, are always more expensive than the traditional way of mining Bitcoin. Oh, this is very important. This is very important in terms of what I said, in terms of things to consider. There are so many different versions of cost of production. What does that mean? Like if a company says they only have $10,000 per Bitcoin cost, per producing a Bitcoin, what does that mean? And here's the problem. When they're saying that, most of the time, they're showing you their incremental cost of production. That's not their company cost of production. That's not their total cost of production. That's not their all-in cost of production. That's the cost of production for the next, latest, greatest, bleeding edge mining rig. And you know what? That's going to look good, but that's not the total cost of production. So that's the problem. They also show you their direct cost of production. And what do they mean by that? Well, most of the time, they mean their direct electricity cost. So that's going to be a low cost too. They're going to show a low cost of Bitcoin production because they're just showing electricity. Then there's something called direct cost of production plus depreciation and all that bad stuff. They're not going to show you that. Then lastly, there's what I like to compare with the energy industry, and that's called the all-in sustaining cost of production. They will never show you that cost of production. So as you can see, they're hiding their cost of production. There's what I like to call, I guess it's a $12 word. It's called obfuscation of Bitcoin mining cost of production, because they're not showing what the true cost of production is. And even if you go in their income statement and balance sheet and cash flow, they've got this other stuff called hosting of rigs to other companies and investors, and they have equipment sales. So we don't know their true cost of production. That's why I say when you're looking at cost of production, trying to calculate it, there's a lot to consider. So what are the key takeaways? Well, in the last slide, I talked to you about one key takeaway, and that's when a company tells you that we have the lowest production cost, that means nothing. All they're telling you is the next generation bleeding edge mining rig. They're telling you that they have like a $8,000 Bitcoin production cost for the next generation ASIC mining rig, but that means nothing. So we must consider the total cost of production, or at least add depreciation to those costs. We also must consider operating cash flows, free cash flows. We need to look at their balance sheet, whether or not they have credit facilities with banks. We need to know if they have cash on their balance sheet. Do they have Bitcoin on their balance sheet? That's what we need to consider. So in part 3, we're going to take a closer look at what I just mentioned, and we're going to try and figure out what the future production cost is and what the future price of Bitcoin could be based on these production costs. Because you have to remember, a Bitcoin production cost affects the price of Bitcoin. It's very reflexive. Remember that. George Soros, in his book, The Alchemy of Finance, he gave us investors a very good thing. He taught us something very important, that there's reflexivity in markets and self-feedback loops, so that everything affects each other. And speaking of which, another thing that affects the Bitcoin price, as you know, is the price of equities. So we need to put all that together, and I'm going to consider that in part 3 of this project on Bitcoin production costs. So thank you all for listening to Lamb's Cryptoverse, and please hit that like button, and please come back and look at all the other videos that we have. Thank you.